What's up, you guys? Welcome back to the Average Joe and Money Financial Channel, and in this video today we are continuing our conversation when it comes to how to start investing in the stock market for the complete beginner out there. And if you've seen the other videos, we've talked about what the stock market is, how does it function, we've talked about the difference between growth and value stock, we've talked about how to do fundamental versus technical analysis, we also talked about the risks in the stock market, how to handle risk, and how to diversify your portfolio, or diversification. And that's really the crux of the conversation we're going to talk about today. Once you've got your account open, you're ready to start investing for your future, you have to ultimately make a decision between investing in individual stocks or investing in something I believe is much better for most people: index funds. Quick note here, guys, if you find any value from this video, make sure you hit that like button below for the YouTube algorithm. I really appreciate it. By the way, you can totally invest in individual stocks and be successful. In fact, you could potentially put all your money on Apple or Tesla or Amazon or all these other growth stocks that are doing quite well in this market, and you could do really, really well. You could make a lot of money. Or you could not. We could find out that Elon Musk decides to quit doing business altogether and go to the moon and stay there. He's not said that, though. We could find out that Amazon ruins every other brick and mortar business and Americans revolt because they don't want to have to shop at Amazon even though they like it. That's not the case yet either. Or we could find out that Apple's iPhones cause men to be sterile if they put it too close to, That's not true yet either, I think. Point is, if you put all your eggs in one basket or you're too concentrated in just a few stocks, you could really get burned. And that's where diversification comes into play. You could buy a bunch of different stocks. In fact, you could buy all of the stocks in the S&P 500, all 500 of them, but that would be kind of expensive. Do some people win by just investing in a few stocks? Yeah, they do. But for the average Joe out there, the average American who's new to the stock market, who wants to start investing for their future, but they don't want to really care too much, they would like to just invest a lot of money into a proven investment that's going to make them a specific amount of money over the long term. Well, if that's you, well, then you got to go with an index fund. Now, before we continue, what exactly is an index fund? Okay, so index funds are investments created by investment companies. Think Vanguard index funds. Woohoo! Think Fidelity, think Schwab, think BlackRock. Lots of investment companies out there, and they've created an investment called an index fund. Now, you might be thinking, what's an index? An index is a specific portion or component of an overall stock market. So you know that there's the New York Stock Exchange. We talked about that in a previous video, and there are thousands of stocks listed on that exchange. But the top 500 are known as the S&P 500 or the Standard & Poor's 500. These are the top 500 companies by market capitalization. It includes companies like Amazon and Apple and Google and Facebook and LinkedIn and Twitter and Walmart and Home Depot and Lowe's and McDonald's and Chevron and Shell and all those other companies out there. The top 500 are in this index, and this S&P 500 index has over the long term outperformed a lot of different investments. So what this investment company does is they create an investment of the top 500 companies, for example, the S&P 500 index fund, and they bring a lot of different investors together, and all their money is pulled together to buy these investments on a larger scale, which is something that the individual investor would not be able to do. So it would cost you tens of thousands of dollars to be able to invest in the S&P 500 individually outside of an index fund, but instead you could buy an S&P 500 index fund and get that immediate diversification for just a few $100s per share. So why would you want to do this? Why would you want to buy an S&P 500 index fund as opposed to invest in individual stocks? That is a great question, and the truth is the S&P 500 index just wins, baby. The S&P 500 index fund is a passive fund, meaning that there is not an investment manager making active decisions each and every day on what stocks to own and which ones not to own, jumping in and out of different stocks. And to be honest with you, there are a ton of mutual funds out there that have an investment manager that buys stocks and sells stocks each and every day. That's called an actively managed fund. But research shows that index funds, specifically the S&P 500 index fund, beats a lot of these other funds, like a lot of them. The Standard & Poor's Dow Jones Indexes puts out an annual report each and every year that talks about how index funds do compared to actively managed funds. And this report details how index funds do in comparison to actively managed funds. And guess what? The index funds almost always win. After 10 years years, 85% of large cap actively managed funds did not outperform the S&P 500 when you include the fees that are involved. And after 15 years, 92% of actively managed large cap funds, meaning big company funds, do not outperform the S&P 500. So not only is an S&P 500 index fund an excellent and very simple way to create a lot of diversification in your investment portfolio, it also is proven to outperform most other types of investments over the long term. In my own retirement portfolios, both my 401k and my Roth IRA, I have Vanguard index funds. Woohoo! I love Vanguard index funds, by the way. So let's talk about this. How do we purchase an index fund now that we're ready to start investing in the stock market? We've got our account open, we've got our money ready to go. How do we do it? Okay, so there are two actual ways to do it. There are indexed mutual funds and there are exchange traded funds. And I don't want that to confuse you because they're essentially investing in the exact same thing. It's just a different product. An indexed mutual fund is an investment you buy directly from the mutual fund company, from a Vanguard, from a Fidelity, from other investment companies. You can purchase a Vanguard S&P 500 indexed mutual fund. Most people actually buy the Vanguard mutual fund directly from Vanguard though, instead of investing with Fidelity and then buying it from Vanguard. If you want to do that, the ticker symbol is VFIAX. This is Vanguard's S&P 500 index fund. Now, a few things to consider here. When you buy Vanguard's S&P 500 indexed mutual fund, there is a $3,000 initial required investment into this index fund. So if you don't have $3,000, you can't buy this fund. And that actually goes for the majority of Vanguard's indexed mutual funds. You have to have $3,000 to start investing in that fund. But after you have $3,000, you can invest increments of $10, $20, $30, $40 at a time into that fund on a continuing basis. You can also buy an S&P 500 index fund directly from Fidelity if you have a Fidelity investing account. The ticker symbol here for Fidelity is FXAIX. This is Fidelity's S&P 500 index fund. And unlike Vanguard, Fidelity's fund has no required minimum. You can purchase it for $25 or $50 as an initial contribution. When it comes to index funds, whether it's an indexed mutual fund or an exchange traded fund or ETF, you're going to have what's called an expense ratio, meaning you're going to have to pay a small fee to the index fund company to invest on your behalf and to manage all of those investments. The great news is with an index fund, whether it's an ETF, an exchange traded fund, or an indexed mutual fund, these expense ratios are very low. We're talking 0.01, 0.03%, which is the equivalent of like $3 for every $10,000 you invest. It's a very small annual amount. So those are indexed mutual funds, and there are other companies that sell them as well, but you have to buy them directly from the mutual fund company. You can't invest in the open stock market. Indexed mutual funds are a little bit different because they're based on the net asset value, or the NAV, which essentially just breaks down to what are all the investments worth inside of the mutual fund. They can't calculate this very well on an ongoing constant basis throughout the day, so they calculate it at the end of trading each and every day. So whether you buy the indexed mutual fund at 9 a.m. or 10 a.m. or 2 p.m., it's going to be based on whatever the value is at the end of the trading day. Now, I invest in indexed mutual funds in my 401k because I have to, but in my Roth IRA, I invest in exchange traded funds, or ETFs, which is essentially the same type of investment. Don't get confused here. An S&P 500 indexed mutual fund and an S&P 500 exchange traded fund are the exact same investments, just a different product. The difference being that exchange traded funds are purchased on the open market. You can buy a Vanguard S&P 500 ETF or a Fidelity S&P 500 ETF or a Schwab S&P 500 ETF or a BlackRock S&P 500 ETF whenever the stock market is open. And you can buy it real time at 9:30, at 9:34, whenever the price is good in your opinion, whenever you want to buy it. That is when it happens, not at the end of the trading day. Exchange traded funds, or ETFs, also have expense ratios, but I've found that they tend to be a tad bit lower in some cases for ETFs versus the indexed mutual funds. So depending on which investment account you have available, whether it's a Vanguard account, a Fidelity account, M1 Finance, Schwab, doesn't matter, just go onto the website, and when you search for the ETF, just search for S&P 500. You can also just Google it to know in advance what the ticker symbol is. For Vanguard, it's VOO, and that's the specific S&P 500 500 index fund that I use myself. And you can buy shares of Vanguard's ETF, the S&P 500 index fund, for only $286.40 at the time I'm looking at right now. So as the average Joe out there, the beginning investor, one of the best things you can do is make the decision to start investing today and then go out and just buy a bunch of index funds. Because for every share of the S&P 500 index that you buy, you are getting immediate diversification amongst the top 500 companies in the United States, and you're investing in an index that is going to outperform, that has historically outperformed the majority of other actively managed investment managers out there. The pros out there who graduated from Harvard and Yale know how to do a bunch of math and portfolio theory. You're beating them every single year for the most part. So this video about the differences between individual stocks and index funds is literally going to conclude our stock market for beginners series. So if you have any questions about what I've talked about thus far, or if you feel like I missed anything, go ahead and leave that 2 cents in the comments below, and I will make sure and discuss that with you directly in the comments. And if I feel that there was major content that was missed that I'd like to do in a follow-up video, I'm going to go ahead and do that. What you can expect from me in the coming week or two regarding new videos is a detailed overview of my Robinhood dividend and investing portfolio. I'm going to break down what the portfolio is, why I'm investing in a dividend portfolio outside of my retirement accounts, and ultimately what I'm investing for. And that's one of the key things you want to understand is, what are you investing for? Are you investing for your retirement? Are you investing so you can retire early? Knowing what your investment goals are and your overall life goals are is going to really drive you and motivate you to win when it comes to saving your money and investing for the future. Now is the time to make sure you leave that 2 cents in the comments below. So if you haven't done it yet, and how have you not done it yet, make sure to hit that subscribe button below and click on the notification bell to be alerted to all of my weekly videos. On this channel, I put out 2 to 3 personal finance videos each and every week designed to help the average Joe out there, people like you and me, with all things personal finance, whether it's how to budget for the very first time, how to pay off your consumer debt, how to invest for the future, and everything in between. So if that resonates with you, consider hitting that subscribe button below and joining the Average Joe on Money financial community. The great news for you is, even though this video is about to end, the learning doesn't have to stop. You can click on these videos right over there.